One of the first things that retirees mess up in retirement is not being able to take advantage of the lower tax brackets offered to them upon retiring. Whether you're a business owner who recently sold your business or you're someone who's worked for 40 years at a company, you know that the last year of your employment probably netted you some of the highest income of your life. The year following that is probably going to be some of the lowest income of your life. Therefore, your income essentially did a roller coaster dive down. While that may not sound good on the basics of that, what's important to know is that you're going to be in a lower tax bracket than ever, therefore allowing you to turn a pre-tax asset in your 401k and your IRA over to a tax-free asset. This is helpful to know for the person who has spent the bulk of their career contributing to a pre-tax account like a 401k or like an IRA and being able to diversify more of where their tax holdings are. Move some of that pre-tax money and take that tax hit today and move it over to a different bucket or open a brokerage account, right? Being able to diversify how your assets are taxed is just as important, if not more important, as how your investments are diversified. This really just speaks to the battle of tug and war, right? Between trying to save today, but also save on taxes over your lifetime, because things like deferring taxes into the future with your 401k contributions can be helpful when you're in a higher tax bracket. But you know, whenever retirement starts and RMDs are right around the corner, the government has every say in terms of how much you have to pay them and when you're going to pay them. So it's helpful to have a balance whenever you're comparing your overall tax that you're going to have to pay for your entire life versus just putting your horse blinders on and thinking about what you're going to have to pay for this year. So if you're someone that's looking to create a long-term plan, I'd be more than happy to help.